Hey guys, welcome back. Today we're going to be going over a particular term which is Roth IRA, which is a type of retirement account. But before I do so, I just want to wish you a happy new year, but more particularly, I hope you have a great financial year. A couple weeks ago, we went over quite a few terms, which included the stock market, what's a share, what's a publicly traded company, what are ETFs or index funds, what is an initial public offering. If you didn't get a chance to watch that video, so I would strongly recommend that you do that before you watch this current video. So what is the term for today? Today, the term is Roth IRA. What exactly is a Roth IRA? A Roth IRA is a type of retirement account. So the IRA stands for Individual Retirement Account. And Roth is the last name of the person after whom the account was named. It's Senator William Roth. Now, what is a Roth IRA? A Roth IRA is an individual retirement account, as I stated, that provides tax benefits. And these types of accounts are called tax advantage account because there are certain tax benefits that they grant to you so that you can invest for retirement. So a tax advantage individual retirement account is an account to which you contribute after tax income. For example, how does that work? So a tax advantage individual retirement account is an account to which you contribute post-tax dollars. And that is specifically for Roth IRAs, because there's also traditional IRAs to which you can contribute pre-tax earnings. So how exactly does that work? If I give you an example, it's going to be much easier for you to understand. So let's say you get paid every 2 weeks. And every time you get paid, your gross pay is $2,000. Now, you don't actually get $2,000. You get a net check amount, right? After all your deductions have been taken out. And some of the deductions include your federal taxes, your state taxes, the contributions for Medicare, the contributions for Social Security, etc. So after all of these deductions are taken out, let's say you have $1,400 remaining. That would be your net income or post-tax income. It's also referred to as discretionary income or disposable income. So if you use that money, you can contribute that to a Roth IRA, and those funds will be invested within that Roth IRA account. So you've contributed post-tax money, meaning money that you've already paid taxes on. And one of the benefits of that is, particularly for a Roth IRA, you will not have to pay taxes on the contributions and the earnings from those contributions if you take the money out or if you withdraw the funds after you've attained age 59 and a half. And which is why that type of account is specifically for people trying to save for retirement. So once again, you contribute post-tax money so that later you never have to pay taxes on those contributions or the earnings that these contributions generate. And just to give you a little comparison, a traditional IRA, which is a traditional individual retirement account, you contribute pre-tax money. So before any taxes are deducted from your paycheck for federal taxes, state taxes, Medicare, etc., contributions are made. So you never pay taxes on those contributions initially. So at age 59 and a half, when you want to withdraw the money for retirement purposes, then you will have to pay taxes then. And it would be up to you to decide which type of account that you prefer. But this video is specifically about Roth IRA accounts, meaning that you'd be contributing post-tax money, part of your discretionary income after taxes and all deductions have occurred, and then you would be investing that within that account. Now, the Roth IRA is simply a type of account. It's not an investment. You would have to purchase investments within that account. And the account is basically the vehicle that allows you to invest and to receive those tax benefits. Now, where can you open a Roth IRA? A Roth IRA can be opened at many major banks or brokerage firms, simply referred to as brokerages, such as Vanguard, Fidelity, Charles Schwab, etc. Now, regarding Roth IRAs or the traditional IRAs, you can contribute up to a certain amount per calendar year. For example, For Roth IRA, you can contribute up to $6,500, and that is for tax year 2023. For tax year 2022, the maximum amount that you could contribute to those types of accounts was $6,000. It's been increased by the IRS to $6,500 for year 2023. Now, you don't have to contribute the entire amount. For year 2023, it's $6,500, but you can contribute whatever you can. You just cannot contribute more than that amount. And now, because the contributions are made per calendar year, generally you have from January 1st of the year through the tax deadline the following year. So if I wanted to use 2023 as an example, I could start contributing to a Roth IRA as of January 1st, 2023, and I would be able to continue contributing for the 2023 tax year all the way through April 15th, 2024. So for tax year 2023, I would be able to start contributing from January through December. So that's 12 months. And then January, February, March, April, and the specific date is the tax deadline for that particular year. So I would have total 16 months to contribute for tax year 2023. So for tax year 2024, I would be able to contribute from January 1st, 2024 through April 15, 2025 for tax year 2024. That's how it works. And one important thing to mention about Roth IRAs and the amount that you can contribute is that you can only contribute earned income, meaning it has to be money that you've earned from working, right? For example, if you work for a particular company and they paid you, you've worked for that income. So that's considered earned income, and you can contribute that to a Roth IRA. If you work as a self-employed person, you can contribute that. For whatever work you performed, whatever services you rendered, that's considered work. It's considered earned income. So you'd be able to contribute to that account using that amount as well. So you'd be contributing to that account using your earned income. Now, if you make less than $6,500 for the year, you cannot invest the maximum. You cannot contribute rather the maximum. You can only contribute up to what you earn, provided that this is less than $6,500. But if you're like an average American adult and you work, hopefully you're making well over $6,500 for the year. So let's say you're making $50,000 for the year, you can contribute up to $6,500 for tax year 2023. Now, you don't have to contribute the full $6,500, but the more you contribute, the more you'll be able to invest within that account. If you can only contribute $2,000 for tax year 2023, then go ahead and do that. Any amount that you invest, and the earlier that you start to invest, the better that will be for you, because you will have plenty of time for that money to work for you, for that money to compound over time. If you do not know what compounding interest is, you can look it up using Google, or you can expect the term to come up in future videos. Now, who's eligible to open up a Roth IRA and contribute to it? Let's say you make $60,000 a year. Yes, you would be able to contribute to a Roth IRA. Why? Because that's considered earned income. However, there's a limit in terms of income that you can have in order to contribute. For example, for tax year 2023, you would have to earn less than $138,000. Most Americans make less than that. So if that applies to you, then yes, you're eligible to contribute your earned income or part of your earned income to a Roth IRA. Now, for married couples filing taxes together, that limit would be $218,000. So as a married couple, you would have to have earned less than $218,000 to be able to contribute $6,500 per person to your individual retirement account. There are more details regarding Roth IRA contribution limits, but we're not going to go over that in this video, because $138,000 for single or $218,000 for married couples, if you make less than either of these amounts, then you would be able to contribute to a Roth IRA and invest within that account. if you make above those income limits, there's a phase out where you'd be able to contribute, but not the full amount. This is information that you can find online if you wanted to find more information regarding that, or if that applies to you. Now, to recap, so what exactly is a Roth IRA? It's a type of tax advantage account that allows you to contribute and invest for your retirement. You can contribute earned income, so it has to be income that you've earned through work. Now, it may be you've worked for an employer or you earned income as a self-employed person. You cannot make more than a particular amount. The amounts that we've mentioned are less than $138,000 for tax year 2023 if you are single, and less than $218,000 for 2023 if you are married and you're filing taxes jointly. And remember that you can only contribute post-tax income, meaning money that you have remaining after all of your deductions have taken place in your paycheck, which would mean that you've already paid taxes on that money. That's why the withdrawals at age 59 and a half and later are completely tax-free. So if you invested just $6,000 or $6,500 for year 2023, and you never touched that money and you never invested additional money, and that amount grows to $100,000, this is purely an example, over a few decades, then the earnings you would not have to pay taxes on. And there are a couple additional things that I would just want to make sure that you guys understand. If you contribute to a Roth IRA, there are taxes and penalties that you have to pay if you take the money out, if you take the earnings of your contributions out prior to age 59 and a half. These accounts were created specifically for retirement purposes. So they want to actually discourage you from taking money out prior to age 59 and a half. Just know that there are taxes, and a 10% penalty may apply for any of the earnings that you take out of the account prior to age 59 and a half. There are exceptions to that rule, just like any rule, and some of them may be you may take up to $10,000 from that Roth account and use it as a first-time home buyer, for example, to purchase your very first home. There are other exceptions, but just know that if you will be contributing to a retirement account, particularly a Roth IRA, and you will be investing, just know that these funds should only be for retirement. If you currently say 30 years old, you would have 29 years and a half to contribute to these accounts yearly and have access at age 59 and a half and after to all of the original contributions, including the earnings from those contributions, and use all of that money tax-free. And the reason being, it's because you've already paid taxes at the very beginning, as you were paid your post-tax income after any deductions for taxes, Medicare, Social Security have been included. That's it. So Roth IRA account is a type of account that you can open if you want to invest for retirement. And now there are different types of accounts that you can open to invest. It doesn't have to be a retirement account, but this particular video is regarding a Roth IRA, which is a tax advantage retirement account. Other types of accounts like brokerages, we can talk about that in future videos. Now I'm going to leave you with this. Did you know that if you're currently 25 years old and you invested $6,500 for 2023 in a Roth IRA, provided that this money remains invested for 34 years until you're 59, say 59 and a half, and you decided to withdraw that money, assuming that you've had an annual rate of return of 8%, that money would equal to almost $90,000. Now that would be only if you invested $6,500 for 2023 and never invested another cent. Now think about how much money you would have in 34 years if you continuously invest $6,500 for 2024, 2025, all the way through age 59 and a half. That's a lot of money. So I really encourage you to consider investing in this type of a tax advantage account. Even if you cannot invest the full $6,500, let's say you can only invest $2,000 or $3,000 for the year, it's better than nothing, and you would still end up with a sizable amount at retirement. Now, hopefully this video was informational to you, that you learned something good today, and if you did, please comment, share, and like this video. I'll see you next week at the next video. Have a good one. Bye.